Right, we're going to move on. We've got a panel coming up. Yes, a panel addressing 2 points: the benefits and shortcomings of forward scenario risk analysis, a holistic approach to strategy and impact assessments, and how can forward scenario analysis aid the development of effective financial regulatory frameworks to allow for the management and mitigation of climate risk. Our moderator is Sonja Gibbs, Managing Director and Head of Sustainable Investment at the Institute of International Finance, the IIF. Sonja, I'm going to hand the floor over to you.
Thank you so much for that kind introduction. It's a great pleasure to be here today. Just a brief word for those of you who don't know us. We're the Institute of International Finance, a think tank and global association of financial firms all around the world, over 450 members, 70 countries. Half of our members are from emerging markets, which is really critical in the context of the need for a just transition. So I wanted to start by mentioning, this is such an important topic, the scenario risk analysis. In a 2021 survey we conducted with EY, over 90% of bank chief risk officers identified climate change as the top emerging risk. And that's so striking, not only in and of itself, but because just 2 years prior, in 2019, less than 20% of these CROs thought that climate change was a top risk. So top of mind for the banking sector. And the past year, of course, has changed the whole landscape for scenario risk analysis. The pandemic has just laid bare our vulnerability to shocks and has been a serious wake-up call on the implications of an unmanaged transition. And of course, the really worrying findings in the latest science from the IPCC, the latest AR6 report, has only made the case for taking action that much stronger. So it's been really catalytic for ramping up action on climate change, and it's particularly in climate risk assessment and scenario risk analysis. And that's being undertaken by supervisors and the financial sector around the world. And authorities in almost 20 different jurisdictions are now conducting or will conduct supervisory climate risk management exercises. And banks are now voluntarily conducting their own analysis for risk management to contribute to disclosure and informed decision making. But, and that's the topic of this panel today, climate scenario risk analysis is a relatively young discipline. And as firms and authorities race to implement their own approaches, the benefits and shortcomings are readily becoming apparent. So it's a great topic for us today. And with that as preface, it's my privilege to introduce a terrific set of panelists that we have with us today. We have James Stacey, who's partner and global director for climate change and low carbon economy transition for ERM. And we have Saumya Mehrotra, who is associate principal for sustainable investment at Qontigo. We have James Vaccaro, who's executive director for Climate Safe Lending Network, and David Barmes, who's senior economist for Positive Money. Welcome, everybody. It'd be good to start off if you could each give a brief introduction of yourselves and your firms and why this topic interests you today. So, James, Stacey, why don't we start with you?
Yes, thank you, Sonja. Delighted to be here today. So quick introduction. Yes, I'm global director for low carbon economy transition at ERM. Also, I think of relevance to the conversation we're going to have today is I was one of the co-authors of the TCFD's technical supplement on scenario analysis, which I guess might explain why I'm particularly interested in the subject that we're discussing today. ERM is a global consultancy working with organizations, helping them really work out at a strategic level what this transition to a low carbon economy means for their future and their future financial performance, what it means to their strategy, but then also working with the same organizations to implement the strategies and the actions that they then identify to be appropriate at a project and asset level, as well as with the corporate center.
Fantastic. So you were responsible for the disruption to summer holidays that everybody spent responding to that consultation then. Thanks very much. So Saumya, how about you? Please introduce yourself.
Sure. Thanks, Sonja. Thanks very much for having me on the panel. I am Associate Principal Sustainable Investment at Qontigo, based out of our New York office. And for those who may not be aware, Qontigo was created in 2019 through a merger of Axioma stocks and DAX by the Deutsche Börse Group. We have both a portfolio analytics offering, which includes a risk platform and an optimizer, as well as index product, and combine that with an open architecture approach where we're able to work with several different best-of-breed data providers. Climate scenario analysis has quite a few interesting use cases for us. In my role, I conduct sustainable investment related research, client engagement. I conduct regulatory tracking and also offer integration support to the index and analytics product teams. Conversations on climate scenario analysis have really picked up pace for us with our clients. And within Qontigo, we're developing our capacity on this front using multiple approaches that I'm sure we'll talk about. So very timely discussion for us. And thanks again for having me.
Thank you. James Vaccaro, how about you?
Yeah, thank you, Sonja. Great to be here. James Vaccaro. I'm the Executive Director of the Climate Safe Lending Network, which is a multi-stakeholder network bringing together banks, investors, regulators, academics, NGOs, all focused on what are the key levers to be able to decarbonize the banking sector. So we bring together peer learning networks of change makers within the banking sector themselves. We bring together groups focused on policy interventions, and we've produced policy papers looking at what are the key to be able to drive climate action, and where are the other kind of systemic levers of influence. The key emphasis of our work across the network, which is started as a transatlantic partnership and is now fairly global.
That's a really interesting point, levers of influence. I think both public and private sector are in search of those now. But David, let me turn to you. Tell us about your work at Positive Money.
Sure, thank you, Sonja. It's a real pleasure to be here. So I'm a senior economist at Positive Money, and we are a non-profit research and campaign organization working towards a money and banking system that enables a fair, sustainable, and democratic economy. I also act as a policy consultant to James Vaccaro's Climate Safe Lending Network, and I've done some work on these topics with him. And at Positive Money, I lead our research on green central banking and financial supervision. In particular, we run a green central banking scorecard, which ranks G20 countries based on their monetary and prudential authorities' green policies. And my background is in ecological economics. So yeah, very much looking forward to this discussion, and thanks again for having me.
Thank you. Yes, no, it's a really interesting scorecard, and thanks for sharing that with us. We wanted to start off with some big picture questions on the kind of landscape for climate scenario analysis and how different actors are approaching it. So Saumya, maybe I'll start with you here and give us a sense of, from an investor point of view, why are investors motivated to conduct climate scenario analysis and kind of inputs they're using? And what are some of the different approaches investors are taking to climate scenario analysis, whether that's top-down, bottom-up? Give us a sense of the landscape.
Sure. Thanks for the question, Sonja, especially because since this really is the most fundamental one, which shapes both the inputs and outputs of what you'll get out of climate-informed scenario analysis. So what I'll do is I'll classify and talk about the two approaches, as you mentioned, top-down and bottom-up to climate scenario analysis. I'll clarify investor objectives with each as I compare them. So in terms of definitions, a top-down approach is where macroeconomic impacts of different scenarios are projected onto sector and company level. And the financial sector is really accustomed to calling these economic impacts economic shocks. But what's important to note here is that with climate, a lot of the impacts will be gradual and not necessarily translate to acute market events. Some examples of these impacts could be a reduction in demand for fossil fuels, changes in costs associated with insurance or productivity losses, insurance losses due to physical damage. So, in a top down model, you'll estimate the impact of these economic activities and project it at the firm or instrument level, say in the form of changes in revenues, costs, or cash flows. In the bottom up model, on the other hand, the inputs will come from the firm level. And shout out to a paper published by the Center of Economic Research at ETH Zurich, which classifies these firm level inputs very neatly and really well into metrics covering exposure, which are mainly measured through GHG emissions and the presence of high emission assets, their vulnerability, which really talks about the financial health of the company, measures the extent to which a company will be impacted in different scenarios. If a company has enough profitability to cover any losses they may incur, or if there's not much competition for them in the market compared to their peers, then they may not get significantly impacted with worse performance. And the final is adaptability, which could cover things like forward-looking things like climate strategy, the money invested in research and development, climate-aligned research and development, and future capex plans. So in speaking to clients, we're getting requests for both, depending on what their objectives are. So at a high level, clients looking to utilize the outputs of scenario analysis for investment decision making in terms of strategic asset allocation are asking for top-down models. They might also be looking for regulatory reporting. And those that are looking for more granular information to help with developing a more specific view of stocks are asking for bottom-up modeling. And before I comment further on the pros and cons of each approach, I'd just like to say that ultimately both approaches are complementary, and investors looking to achieve a holistic picture on their climate risks and opportunities should adopt both in conjunction. So just comparing quickly the two of them, a top-down approach takes into account systemic risks and it is helpful in translating the impact of those risks onto the direction portfolio should take at high-level investment decisions. But bottom-up analysis gives you the power to be more discretionary, even though it might require more time, effort, and expertise. It really gives you the opportunity to look at a company even in relationship with its transition plans, which then becomes important to create a real change in the economy. The idea should be to drive company towards eligibility and not divest from entire sectors based on systemic risks. But yeah, just to sum it up, as I said, we're looking at it from both perspectives at Qontigo, and investors should look to develop views on both ends of the spectrum.
Thank you, Saumya. That's a really interesting overview of kind of some of the design issues and challenges that go into scenario analysis. And James, Stacey, maybe I can turn to you now. When you think about how investors are using these tools, how should investors sort of both anticipate and address these climate-related financial risks, and at the same time bearing in mind their fiduciary duties of maximizing investment opportunities? And how are investors and lenders assessing alignment? You mentioned your work on portfolio alignment. Please tell us about it.
Yeah, that's a great question. I think to the first part of the question, first of all, financial institutions are now putting in place governance frameworks, adjusting decision-making processes, essentially integrating climate-related financial risk and opportunity into the day-to-day running of a business. That's a really important step, maybe step one. The next area of response that we're seeing is really building capability and capacity at both a human level and a technology level in order to really equip the organization with the knowledge and expertise to be able to navigate the transition. And with that comes a need for data and organizations are putting in place data hierarchy solutions in order to enable them to have the right inputs to then undertake the scenario work that Saumya was just explaining, which really is the next key step, is formulating a house view on what the risks and opportunities are that are going to play out for counterparties or investees, depending upon whether you're banking or investment. And that means running the different scenarios and really becoming intimately involved with those scenarios to the extent that the organization really understands what the levers are that will influence whether one scenario or another plays out. Now, that can inform risk management, but it will also be informing commercial strategy for the finance house. And this commercial strategy piece is very important, both in the context of risk management, but also then maximizing the opportunities that was the component of your question. Where we're seeing on the banking side, organizations now recognizing that certain parts of the economy have a really very exciting future as a result of this change dynamic. Other parts of the economy have a challenging future and one that requires material change. Now, both those dimensions require financing, and that creates opportunity. And of course, as a result, we're seeing specific financial products emerge in the market that respond to those needs. Now, in terms of how our financial institutions then assessing organizations' alignment with the transition, we are beginning to see a number of financial institutions produce methodologies that allow that institution to track their portfolio or their lending book against particular scenarios of decarbonisation. So, for example, we've seen organisations come out and produce methodologies that determine how their oil and gas lending book, for example, how that will evolve over time if it is moving in a trajectory that's aligned with the Paris Agreement. Now, that gives the financial institutions some clear metrics that they are now tracking for their counterparties or investee organizations. Those metrics tracking year on year on that Paris trajectory. That starts to allow the institution to interact with each individual counterparty or investee around, well, where are you on this journey? Are you ahead of the curve? Are you behind the curve? It opens up very rich conversations with those other organizations around strategy, around financing needs. And of course, from the financial institution's perspective, they are able to track whether their portfolio or lending book is moving in the direction that they would want it to if their objective is to be aligned with a particular scenario of decarbonisation. Now that then opens up really interesting questions for the counterparty or investee organisation, and where their key stakeholders within the financial services industry are developing these methodologies and evaluating them against those methodologies. So that becomes a very important input to the corporate strategic response and what they would then want to be doing and the actions they want to be putting in place within their organisation in order to ensure that they themselves are moving in a direction and at a speed that aligns with their financial stakeholder expectations.
One quick follow-up for you, and then a question we have from the audience, if you don't mind. The follow-up is, you mentioned these different methodologies and these different metrics evolving. Because there are different initiatives working on them, how can they be comparable across firms? Does this concern you? Does this worry you?
That's a great question. So right now, there really is an absence of standardized methodology for evaluating how a lending book or an investment portfolio is moving along a decarbonisation trajectory. So we are seeing organisations produce their own. And that innovation, I think, is healthy at the moment We see different organizations produce slightly different methodologies. That creates debate around, well, what is the right methodology? It makes it slightly more complicated for the corporate entity that is seeking to respond to these methodologies and align their own business with them, because clearly there are different metrics and different values of metrics that they are now being asked to connect to. But I think it's a rich process at the moment, and it's part of and reflects the learning curve, really, that both the corporate sector and the financial services industry is going through in terms of determining what are the right metrics and what are the right trajectories that you would want to be aligning to. So I think it's rich and it's helpful at the moment. And I think the methodologies that the financial services industry are producing and putting into the public domain in quite a transparent way in many cases is helpful in terms of engaging the corporate sector then around where a very important stakeholder has expectations for them to be going.
Very helpful. Thank you. David, let me bring you into the conversation here, and let's talk about central banks and their use of climate scenario analysis and stress testing. How far has this process gone? Where do you see it going?
Yeah, thank you, Sonja. I think this is a really hot topic at the moment in the central banking world. A growing number of major central banks are increasingly engaging in what's often referred to as climate stress tests in the media, although generally these are not actually real stress tests per se, because stress tests usually have implications for capital requirements, but prudential authorities have not committed to that yet, and so they have a range of other names for these exercises. So the Network for Greening the Financial System, which is the main forum for central banks and supervisors collaborating on climate issues, has published updated scenarios over the summer. And these are being used by central banks and prudential authorities in the UK, in Australia, Europe, Brazil, and elsewhere. And the purpose of these exercises is, of course, to assess the nature and extent of climate-related financial risks across their respective financial systems. And my view on this is that exploring these risks is, of course, broadly positive. But I think these exercises have at least three key limitations. First, the NGFS scenarios and the integrated assessment models upon which they're based, I think are very limited and have questionable assumptions about the scale of economic disruption and damages, and about unproven and untested technologies. Second, even if we improve the scenarios, I think these assessments will ultimately not be capable of accurately quantifying climate-related financial risks due to the radical uncertainty that characterizes these risks. This year actually marks 100 years since Frank Knight and John Maynard Keynes made this distinction between risk and uncertainty. Risk being something that has a calculable probability of occurring, whereas uncertainty being something describing a situation that is fundamentally unpredictable and unknowable. And I think although this has been somewhat lost to the economics and finance profession, it's now being revived in the context of climate-related financial risks, especially as economists from the Bank for International Settlements and the French Central Bank have acknowledged that due to radical uncertainty, climate-related financial risks cannot really be accurately quantified, and therefore scenario analysis is an insufficient strategy to guide decision-making. And the final point, I think, is that there's a real risk here that while regulators kind of bury their heads in the data, they may be delaying action to effectively manage and mitigate risks that are either already materializing, like the COVID-19 pandemic, which is climate related or more broadly nature related, or risks that are growing at a rapid and systemic scale. So, I think storytelling through scenario analysis can be a powerful tool, but stories about the future are all ultimately fictional, while climate impacts are already very real. So shifting focus from passive data collection and modeling towards proactive regulatory action based on the information that we already have, I think is necessary to help us navigate this world of instability and uncertainty.
Yeah, so in other words, you're agreeing with Frank Alderson, the chair of the Network for Greening the Financial System, when he says patchy data is better than no data, and we just need to move forward. It's an interesting
Absolutely.
point.
Yes.
Now, also the distinction, I think, between climate scenario analysis and stress testing is an important one, right? Because in stress testing, which is generally kind of short-term in focus, it's very hard to rely on these medium to long-term climate scenarios, which, as you say, are so fraught with uncertainty. So thank you. And James Vaccaro, that's actually a nice segue to a question we have for you. And you have mentioned or argued that we need a task force for finance-related climate impacts. So this is the outward-looking focus. Why do you think the framing of stress tests in this context may be too narrow?
Yeah, so I mean, maybe just to begin with on some of the yeah, I mean, in all of this, there's a distinction doing things right and then doing the right things. And at the moment, everybody is incredibly busy across the finance industry, almost overwhelmed in terms of risk analysis and modeling and preparing for stress tests. In the recent European Central Bank scenario analysis, where they modeled the probability of default for the hothouse world scenario, and that's basically where you kind of get runaway climate change. By 2050, they thought, well, the probability of default across banking portfolios on a top-down approach, from what Saumya mentioned before, was around 2.3%. Now, here's where sort of there's a risk in terms of the data, in terms of, well, look at what the probabilities would have been in COVID just now, were it not for in and guaranteeing massive swathes of the banking sector. Look at the loss and damage in climate now, whilst we're at 1 degree warming, compared to what we're currently seeing in towards 7 degrees warming, or triggering in these world scenarios impacts of climate change. Something kind of deeply in need of sense checking as well as to get better data. But all of this is about sort of doing the right things within the TCFD approach, which is the necessary element of assessing the inward climate risk scenarios. In other words, how these climate changes will affect financial institutions. Systemically, however, it's not just about the vulnerability of the financial institutions, it's about the causality of distribution that financing high carbon assets is doing towards producing climate change and tipping us over these things into runaway scenario. You could, for example, manwood risks by 10-year lending. A lot of fracking is that way. You could withdraw from lending to mortgages in areas and leave amounts of community out without mortgage facilities. You're lending to major oil and gas sovereign backed. It's like, from a risk perspective, you might say you're covered. But from a solution to climate scenario, where a lot of the actual impacts might be felt way beyond what Bank of England or European Central Bank are currently looking at, which is 2050. The way it works is that it continues to cook beyond sort of turning the heat off. And that is the ultimate kind of problem and challenge for regulators, if they are mandated, as they should be, for the long-term financial stability. So all of this kind of comes to, well, how do we make sense of those contributions? How might we act in a way to make such contributions now through the same kind of tools that regulators, measures or whatever? And how do we go beyond penalizing sort of the vulnerability aspect and only and also looking at the contribution aspect. On a geopolitical analogy, Africa probably contributed the least to climate change, yet its credit risk will suffer vastly because it is going to the places on Earth which is going to be most vulnerable. We need to think forward in terms of how do we address the architecture of financial stability in the right way, which balances these risk impacts.
Those are really interesting questions, particularly around the central bank mandate issues, right? I mean, do we move beyond the sort of microprudential risks to a bank's own balance sheet, the macroprudential, broader financial stability, to something more along the lines of realigning capital flows? And different central banks are obviously going to have different views on where they are on mandate. It was really, really interesting. Thank you. Saumya, let me come back to you here, and let's get to some of the sort of inherent challenges in using some of these forward-looking climate metrics for climate risk analysis and stress testing.
Sure, and this is something we talk about in a paper my team at Qontigo and I recently published. We talk about the confusing landscape of forward-looking climate metrics and how investors can navigate it. One of the things we find ourselves really challenged with, both in terms of scenario design considerations and impact modeling, and this is something I'd love my fellow panelists' input on, is the sheer number of assumptions involved at various different levels. Climate scenario analysis is meaningful only when you're able to change inputs, change assumptions, and see what the impact is. Now, when it comes to climate, these could be endless because the number of systems involved vary a lot in terms of scientific inputs, regulatory changes, technological developments, demographic shifts. So, on the one hand, it's hard for just one entity to be an expert in everything, all these systems. So, not everyone can develop a comprehensive impact assessment model. How we are thinking of tackling this is to make sure that the client sees that the process is well thought through, even if we use a third-party provider. The second is that the level of flexibility that's required to integrate these assumptions is hard to bring into a model. So it's good to have conversations with your clients on where is it that they'd like to insert their assumptions, which will ultimately be based on the questions they're ultimately trying to answer. And some of the other challenges are things that my fellow panelists already spoke about in terms of uncertainty around climate science. The climate science is still evolving in terms of even things like the amount of GHG emissions that will create, the level of impact, physical impacts that we're looking at. There's a lot of black boxing of data provider methodology. In our paper, we look at 3 different climate metrics with similar underlying methodologies that are measuring climate risks for certain companies. And all the three metrics, even though they're similar, have a lot of divergence in how they measure each company. So very low correlation across data providers on forward-looking climate metrics. And the third challenge, I would say, is the fact that not enough forward-looking climate metrics exist. And a lot of investors are still relying on past GHG emissions data to model future assumptions, not taking into account things like climate strategy, transition plans, future CapEx, R&D investments. So this is something that a bottom-up approach really makes possible for investors to look at climate risks in conjunction with transition plans of a company. So yeah, I'll just stop there to see if there are enough comments.
Sounds quite daunting, challenging. And James, Stacey, maybe you can pick up on some of Saumya's questions, because so given this, why would a company want to invest in forward-looking climate scenario analysis, and what does best practice look like here?
Yeah, and I think, Saumya, you've set me up, I think, for this question very well with some of your response a moment ago. I mean, maybe I'll give my response a bit of context. I've done a lot of scenario analysis for many different corporates across many different industrial sectors, following the top-down type approaches that Saumya was talking about, which is typically adopted by organizations that have got large portfolio exposures, but also bottom-up, which is obviously the direction that most corporate entities follow, where they really want to understand the granular detail around how their business will be affected by different scenarios, i.e. different trajectories of decarbonisation, and therefore different levels of actual physical climate change manifesting themselves. So to answer the question, I'll answer it from the perspective of the variety of clients that we've worked with here. First of all, what we're talking about here is it is a defining variable to the future financial performance of many companies. So that in itself makes it a subject that is significant in terms of an organization wanting to understand it more. Now, why run more than one scenario? i.e., why do scenarios? And that's really about a point that David touched on earlier, I think, which is uncertainty. We do now have confidence that governments are going to act. We can see the direction of travel here. The world is going on a decarbonisation journey. But what we're not sure on is the speed and therefore how that decarbonisation journey will affect different sectors at different points in time. So why scenarios still? And the answer to that is because the financial consequences to many organizations are materially different according to the different trajectories of decarbonisation that we go on. A 1.5 degree future and a well below 2 degree future, they might not sound like they're hugely different to each other when we talk about potentially going to a 4+ degree future if we don't do anything. But actually, the difference between a 1.5 degree future and a well below 2 degree future can be very significant to the future financial performance, particularly over the next decade, for many industrial sectors. So understanding that is really valuable if they are to then have a strategic response for their organization that is valid to those different pathways that still remain viable right now and are both plausible pathways that the world might take. So really important from a self-interest perspective that corporates or financial institutions run scenario analysis because of the difference that those trajectories present to their business and their business performance. But if that isn't a big enough reason for them, then of course there's the reaction that we're seeing now from the capital markets, where we are seeing banks, investors, and the financial regulators effectively demand that organizations do this in order to evaluate their own risk profile and their own return on investment trajectories. So there is a self-interest argument here around a management team, a board, wanting to understand this change dynamic to a level of detail that they can start to plan how to navigate it. But there is also a driver in the sense that if they are accessing capital, then they will want to be able to meet the expectations of the capital markets, which are for organizations to be able to articulate what these different scenarios will mean to their performance and how they've built that into strategic plans.
Really interesting. And David, let me turn to you here because James has been talking about private sector approaches, but tell us what kind of supervisory and regulatory policies you think are necessary to really manage and mitigate these climate-related financial risks.
Sure, thank you, Sonja. So I guess in terms of what we've seen so far, it's only really been microprudential mostly, other than the system-wide scenario analyses. We've seen microprudential Pillar 2 and Pillar 3 measures, so focused on disclosures and the supervisory review process. And I think what's really missing from current approaches are Pillar 1 measures, meaning minimum liquidity, but more importantly, minimum capital requirements. So one policy in particular that is receiving an increasing amount of support is a 12-50% risk weight for exposures to new fossil fuel projects, which would, of course, increase the cost of financing these assets and protect financial institutions against fossil fuel assets' eventual and inevitable loss of value. This is something that the Basel Committee recently proposed for crypto assets, and I think there's a clear case for extending it to new fossil fuel projects at high risk of becoming stranded assets. And of course, the IEA's net zero scenario suggesting that net zero by 2050 requires no new fossil fuel projects beyond those already committed to in 2021 really adds legitimacy to this argument. And of course, risk weights can also be adapted for existing fossil fuel exposures, as well as for other types of exposures that are closely linked to highly destructive activities, such as deforestation, for example. It's also then worth, I think, looking beyond the micro level at how macroprudential risk-based measures like systemic risk buffers, even countercyclical capital buffers, as well as potentially capital surcharges for globally systemically important banks. These can all be adapted for climate risks, to account for climate risks. And then one step further, I think, is looking beyond purely risk-based policies, as James Vaccaro was getting at, and actually looking at climate impacts and alignment of financial institutions with environmental targets. And on this front, regulators, I think, in collaboration with finance departments, should consider requiring mandatory transition plans for financial institutions, and potentially even limiting or even banning the financing of certain particularly destructive activities. So this is the kind of double materiality approach. But I think, even if we want to just manage risk, if we're just looking at inward risks and opportunities, that still ultimately requires looking at impacts in order to effectively manage those risks in the long term. So yeah, those are some of the policies that we're looking at Positive Money, as well as at the Climate Safe Lending Network. James Vaccaro may have some thoughts to add on those. And yeah, I'll leave it there. Back to you, Sonja.
Indeed, that sets James Vaccaro up very nicely. I think, just to say, David, that's a really interesting overview, and I think brings in some of the questions we've been talking about central bank mandates and the maturity of the toolkit to do all of this. Big challenges ahead. So James, let me turn to you here. And, what might be some of the consequences that aren't being picked up enough in stress tests now, and what would need to change to make it truly effective?
Well, yeah, this really picks up, I think, Saumya's challenge in terms of and James's points as well about how do you design scenarios, and at a very basic principle level, there's a complicated mindset, which is that you can, if you knew all the data, map things in, and you can kind of linearly kind of figure out, although it's very complicated to do so, what the outcomes might be. The other approach says that actually there is just too much interconnectedness here within the natural world, within social and economic systems, to say that this is actually complex, and it isn't possible to model to that degree. And there are lots of things which are non-linear. If you look at COVID, there was nothing in the past data sets which we could have used to create scenarios which would have effectively been able to model, on the basis that we're now modeling for climate, what actually happened for COVID. One of the impacts that we kind of maybe didn't predict was that, well, when you get something beyond a certain tipping point, governments, as it turns out, can shut down entire economies because it's about protecting human life. or that businesses will be forced to maybe pivot business models, and workforces who would never even think about remote working would make that switch very quickly. So there's a lot of this, these sudden and rapid changes which might be triggered in this inevitable policy response, which might be uncertain, and it may happen at this very sudden way, which can't be modelled in a sort of a in a neat kind of in a neat way. The other factor that we are aware of in terms of climate change is that beyond certain thresholds, with the feedback loops within what we understand from the science, we might reach a point where we are no longer in control. In a lot of economic modelling, you might say, well, if you go too far in one direction, you can always rein it back in, or you could bail it out, or government could create some ways of being able to bring something back to a manageable equilibrium. That is not how the planet works. And it's a sort of the King Canute position that we can control this. At a certain point, we lose control. And the only rational way to deal with that type of non-linearity is to adopt the precautionary approach. And that's where it threads together with David's points in terms of, well, how would you act in a precautionary approach? Well, you do things, you put the brakes on to manage the global commons, the stocks and carbon budget that we have, in order to not go beyond that precipice. And we don't know when that's going to happen. We don't know what the trigger's been. We've seen wildfires, we've seen floods, we've seen storm damage already. It hasn't seemingly triggered the degree of policy response in the way that COVID, or in Europe, the gas crisis has right now. But if it does, then that changes a lot of the fundamental basis of the modeling upon which climate scenarios are being based right now. And that is why being able to look at some of these precautionary approaches and the principles for how we regulate is so important.
Perfect. Well, I'm afraid we are approaching the end of our time here. I did have one last quick question from the audience we could maybe touch on if someone would like to pick it up, and that is around nuclear energy. And I guess the question would be around, how do you look at scenario analysis from the point of view of the nuclear sector? If anybody would like to pick that up.
Well, I've got a feeling that actually the best real stakeholder to pick that up might be the insurance industry. If the insurance industry really feels able to underwrite the risks and understand it, then that would go a long way. At the moment, it always tends to kind of fall back to sort of a government support to be able to kind of look at some of the underlying risks in terms of production, storage of waste, and those kind of factors. So I think that one of the things there is to really look at, well, can it really stand up on its own 2 feet from a commercial insurance perspective?
No, that makes a lot of sense. And thank you for taking that question. And as we are at the end of our time, I just want to thank all of you, Saumya and David and James and James, and to the organizers for putting together such a terrific group of people. It's been a really thoughtful discussion. Thank you very much.
Thank you.
Sonja, thanks everyone.
Thank you.
It was a thoughtful discussion. What an excellent discussion. Thank you there to Sonja Gibbs, Managing Director, Head of Sustainable Finance at the IIF, the Institute of International Finance. Everything you needed to know about forward scenario risk analysis. I love that quote, patchy data is better than no data. Yes, that's a true statement if ever one was said. Going into depth, such analysis, wonderful. Stress testing, integrating climate change, into the investment process. Is the community engaging? How does it work? Should all financial systems be aligned with climate risk resilience, programs? Brilliant, brilliant, brilliant.